Hello, everyone. Welcome to this month's live market update. For those of you who are new to my updates, my name is John Pasalis. I'm the president and broker of record at Realosophy Realty in Toronto. I started my own brokerage to put into action my belief that consumers with access to the right information and the right advice will make better real estate decisions. And of course, that's important because our real estate decisions have an outsized impact on our finances and quality of life, of course. If you're considering buying or selling or investing in the Greater Toronto Area, you can click the link in our show notes to set up a meeting with me and one of my agents, or you can always email me at askjohn@movesmartly.com. And now on to today's market updates. So today we're going to be chatting about a few different things. Let me pull up our agenda here. As always, I'm going to kind of give a quick update on sort of what are the trends going on both for houses and for condominiums. I'm going to kind of revisit a post I put up a couple months ago about the housing market turning a corner and to look at how some of those stats changed. I think I mentioned in our email update, I was going to chat about the student housing situation and the caps, but I have a video on that, so take a look at that if you haven't. And then I'm going to bring on Gus and Davin again from our brokers to chat a little bit about the trends they're seeing on the ground. I'm seeing on the ground. So more of like a on the ground look rather than just the statistics and the data. And then finally, as always, we're going to have David Larock, mortgage broker, chat a little bit about the mortgage market, but also helping us answer this question about whether or not sort of this heating up we're seeing in the market, whether it's going to last, because there are some trends in the bond market, if interest rates that might signal maybe things might slow down a little bit. So we're going to have David Larock joining us shortly to chat about some of those trends as well. So just quickly taking a look at some of the trends that are going on, to kick off the new year in the market for houses and for condos. When we look at the stats for detached low-rise houses, sales are up about 27% over last year. Sales are still below the 10-year average, so we had about 1,700 sales or so, 1,750 in January. Typically, we have about 2,000. So we're below the typical long-term average, but we're quite a bit higher compared to last year. New listings were flat compared to last year, so no big change. And they're also below the 10-year average. So new listings for detached homes are pretty tight. And when we look at inventory levels or active listings, they're down 9% over last year, and they're also below the 10-year average. Now, the key thing when we're looking at sales inventory, of course, is a relationship between sales and inventory, the months of inventory. So that's just looking at the number of active listings, which is about just over 4,000 divided by the number of sales. And that gives us an idea of how long it would take all the homes currently on the market to sell if nothing else got listed. And that has been plummeting. Months of inventory peaked at around 4 months for low-rise homes. We're just over 2 months now. So the market definitely is tightening up, is becoming more competitive. Prices, we see if we take a closer look, they have been trending down. They peaked in the spring of last year. They've been trending down. But right now, they're actually pretty much, flat. They're about down 1% over last year. So the average low-rise home, about 1.26 million. We're flat over last year. If inventory levels continue to stay tight, that's typically the grounds for the market, at least prices stabilizing, if not increasing. So the lower the inventory is, typically we see more competition and pressure on prices. And we're starting to see that on the ground. If you see your news stories about bidding wars and things like that, that's what's driving that. I forgot to mention, as always, if you have questions, comments, please post them in the chat. Urmi Desai, our editor at Move Smartly, is keeping an eye on those. And of course, we'll be taking your questions throughout the discussion today. So quickly touching on the condo market. Condo sales, interestingly enough, are up 40%, which is in many ways, they've outpaced even the low-rise sales, which I don't think many people were expecting. We are just under the 10-year average for condo sales. Of course, we saw those big spikes in during COVID 21, 2022, but we're just below the 10-year average. Now, new listings are also up, unlike low-rise homes. And we're roughly around or just above the 10-year average. Now, when we look at active listings, there's a number of condos available for sale, is up 26% over last year. Now, this, of course, is basically a carryover because inventory levels were quite high from the fall market, and they're kind of spilling over. So the key thing, again, when we're looking at inventory, is this going to be growing or is this declining? And we can kind of see this with the months of inventory, again, which has been falling for condos. And when the months of inventory is falling, it tells you sales is basically accelerating faster than active listings are. And the conditions are basically getting tighter. So we had over, about 5.5 months of inventory a few months ago. We're down to 3.5 for condos. So the condo market's still quite a bit slower, but again, these are signs that the market is tightening up, that it's getting competitive, that sales are outpacing active listings. I think the condo trends are ones that caught I think most people in our industry by surprise. I mean, I think most people thought it was going to pick up and not this aggressively. To see a 40% increase in condo sales is pretty amazing in this environment. Now, when we look at prices, condo prices are about just over 700,000 and pretty much flat over last year. So no material change. So those are some of the key trends we're seeing right now in terms of sort of the stats. So the market's definitely more competitive than it was in the fall. Both condo numbers and low-rise numbers, the markets are getting tighter. There's less inventory. So before I bring on Gus and Davin, I thought I would actually just touch on a couple of slides I presented 2 months ago in our live update in December that was largely based on November data. And basically what I was showing back then is I was asking if whether or not the housing market's turning a corner. So in the fall, the market was very sluggish. And I thought, I just stumbled across these slides and I thought it'd be a good idea to revisit them because it's a good example of how we can sometimes see these shifts in the market before, they become the common trend. So like the big shift, happened in January, but it didn't just, market just didn't turn on a dime. Some of the trends we saw kind of happened a lot earlier. And if we look at a couple of charts that I'd show, this is from back in December's presentation. I looked at the sales to new listings ratios for houses. And again, what this was showing is that the number of homes selling was, again, outpacing the number of new listings coming on the market for houses. And this is looking at weekly statistics. And what was happening in the spring and fall is sales to new listings were declining because sales were falling, new listings were outpacing them. So it's a sort of downward trend. But as we got to sort of the end of October and most of November and early December, sales to new listings ratios accelerated. And again, that's a sign that the market is heating up again. And then when we look at a very similar chart for condos, we saw not as big of an increase, but the sales to new listings, even for condos, were picking up. And when we look at the months of inventory, so if we look at, I showed a chart where we're looking at a months of inventory on a weekly basis. And we could see when we were looking at it back in December, and this is kind of when this chart ends, we see that, during the spring market and summer market and fall market, months of inventory or houses or condos was basically skyrocketing. They went from, houses were about 1 month of inventory. They went up to 4. Condos were about 1.5. They went up to 5.5. The market turned on a dime. But by the end of the year, inventory or months of inventory started to turn a corner and they started to decline. And that was when, at the time, and we didn't know this was going to be a significant trend, but it was a sign that the market potentially was starting to turn a corner. If we fast forward to today, inventory levels, weekly have been plummeting for condos and for houses. If we look at it even on a weekly rolling basis, houses have about 2 months of inventory, condos have 3 months of inventory. So again, I think the key thing I wanted to look at these is because when we think about the shifts in the market, some of these turning points in the market, there are signs earlier. I mean, I didn't predict that this is how the market was going to unfold in January, but there were clues. There were clues that the market was starting to turn a corner. Inventory levels were declining. So there were some clues in the market. I did not anticipate it being this competitive, but it is interesting to see some of these shifts that we're seeing on the ground. So on that note, I'm going to bring over Gus and Davin to join me to chat a little bit about some of the things that they're seeing on the ground that kind of go beyond sort of the data and the charts and all of those things. So thanks, guys, for jumping on.
Of course.
Davin, maybe we'll start with you. What are kind of some of the key things that you've been noticing over the past month since our last update in January?
Well, it's been kind of similar as to what was happening last month. I guess there's just continued demand is there. Listings do remain low, most in the freehold market, but we're not seeing any kind of spikes in condos. It's kind of staying reasonably consistent. And I'm seeing even more so the phenomenon, for lack of a better term, of inventory being snapped up pretty quickly. Again, prices aren't crazy. There's the one-off that sells for 50, 100K more than it should. You can't stop those buyers from doing something a little silly, but for the most part, it's things are selling at value. And again, if product is shown well, produced well, kept well, it's gonna do pretty well. I had a interesting chat with somebody, a friend of mine who has acquaintances who co-own a investment condo. He came to me with a question, and I was wondering what you guys would probably do or advise. And the question was basically this. So they have an investment condo. The tenant voluntarily left, and one person says, "Let's get out of the market. Let's sell this condo." The other person says, "Let's rent it again for 1 year and sell next year when they perceive things to be actually better." So the short story from me, was going through the pitfalls of having it tenanted again and then selling it again next year, because if you don't have a vacant property at that time, it's gonna be a little harder to sell. And they've been given, if they do want to sell now, they've been given a gift of a vacant condo. And I kind of just presented that to them because I know you have some harrowing tenant stories I think you can finally share. I'm not sure if you can yet.
Okay.
And that was basically the long and short of it. So it's basically this difference between sell now for a known-ish value, like we have a general idea, or projecting 12 months down the road, but selling a potentially tenanted condo. And that was basically I mean, the thing that didn't come up was don't sell it at all and keep it, but it didn't sound like that was one of their options.
That's a great question. And I think it's, for those who, I posted a video this week on our YouTube channel about some of the challenges selling tenanted properties, and there can be challenges. And I don't know if I'd ever advise to just hold on for a year and sell it tenanted for exactly the reasons you mentioned. I mean, you don't know what the tenant's living condition is going to be like. Like some just aren't, they're not spotless. It's a mess. You walk in the flat and there's clothes everywhere and there's food everywhere. Like that, those are not good conditions to list a condo, right? Plus, like I mentioned in my video, you have this whole challenge of, dealing with the tenant. And what if the tenant doesn't want to move out? Then you got to pay them cash or keys, which can cost you thousands of dollars anyways to have the tenant vacate. So
that was one of his bigger worries, was the cash for keys setup. So,
I don't know. My advice would be either you just sell it now, or you just rent it and, again, wait for the tenants to move out, because trying to navigate selling a tenanted property, like I said in my video, like they don't usually, aside from dealing with the tenancy issues, most tenant properties just don't sell for the same price that a vacant one would. They don't show as well. There's these concerns. So yeah, that's to
be clear, they'd be making maybe $400 in positive cash flow. So it's not like they HELOC themselves to death on this condo. So there's that consideration of the rents, and of course the equity built via the
Mhm.
rents. But again, we're assuming that it's going to be much better in 2025, same time this year, to sell. And for the condo space, I don't know. If it was a freehold, maybe there'd be a little more solace in that. But again, that's a long
Yeah,
runway to
it is.
guess.
That's a good story. And your other story about places selling for value, I think is an important one. And I think a lot of buyers miss, what's not said in many of the headlines when you see the headlines about 10 or 15 or 20 offers on homes is that the vast majority, like Davin said, are selling for relatively, I don't want to say like market value prices. I mean, even though they might be 100 or 200,000 over asking, many are selling for value. It's the few outliers that maybe overpay, but most are selling for reasonable prices still, I'd say, in terms of market comparables. Thanks, Davin. Gus, what do you kind of have been seeing?
Yeah, I mean, definitely a little bit more of the same in terms of demand, more so on the freehold, but a little bit of an uptick on the condos as well. I have a couple condo listings up. Like did some research on W1 waterfront this week, where I have a listing, and how many sold in the last 2 weeks, and how many sold above asking. And I found 6 out of 42 sold above asking, and 36. Sorry, my math is wrong there. 30. What did I say? 42, 30. Yeah, 30. Yeah, that's right. 36 did not. They sold at asking or less, and most of them were less. So, I was actually surprised that 6 sold over asking. I was expecting the number to 1 or 2, but and on the listings that I do have, yeah, we've had offers early on, but there's still that I guess Davin had mentioned it on the last chat we had, where there's kind of two different markets. Buyers are thinking they can get a deal, and possibly they can on the right property. I'm not saying they can't. They can get a deal on just about every property, and that sellers are a little bit desperate. And sellers are thinking, well, the market's moving forward and demand is high, and look at sales, 40% on condos and 30% in freeholds last month. So they're thinking, well, maybe I'm worth more than the evaluation that we talked about last month, right? And there's that tug of war, so to speak, between the two. I'm finding. I've also been speaking to, I can think of 5 that have debated that exact topic that David just brought up. Do I sell now, or more so, do I sell now or do I sell next year? It's hard to time the market. My thoughts are, and my question back to them is, do you think the market's going to appreciate 10% or more in the next year, next spring? And if it is, well, then maybe, yeah, that's a tidy profit to wait. But if you think it's only going to appreciate 3% or 4%, which is, again, I'm not trying to predict it, but looking at, they haven't even cut rates yet. They probably won't cut till later in the year. I would think it's highly unlikely we get a big jump at the next spring. I'm not saying it won't be busier, but I don't think it's going to be a huge jump. And so if you only hold on to it for a year, think of the costs that you're putting back into it. If you have a tenant, like you talked about, and the risks of selling with a tenant, all those things, I don't know if it's worth it. My advice was I would say just hold it for 5 years, and try when the market's hopefully a lot better, and you get build your equity that way. But not everybody's in that position, of course. Yeah, so overall busy. I am seeing, listings, hearing of listings. Talking to Courtney, our stager, this week. She's swamped. She's got to go buy more furniture.
Mhm.
She doesn't have enough furniture to stage the places she has. She's not the only stager that's told me this. Photographers we deal with, the photograph places, they're very busy. I tried to book our cleaners, who she specifically works with realtors listing places. She's like, I can't clean your place this week. I know you give me 5 days notice. I can't. I'm slammed. Four cleanings a day. I got to do it next week, Monday. So, and that's typical for this time of year. It's important to state that it does get busy, but I don't know. I can't I just have this feeling that it just seems a little bit extra. We're going to get not a huge rush of listings, but a little bit more listings than we would normally. And that's because of the, again, attitude of sellers that, hey, this is a good time to sell. I've been waiting. I didn't want to sell last year. Let me sell now. But there's also the buyers that are like, rates are coming down. Let's get in the market. So, I mean, you have both dynamics working. I'm not saying we're going to see listings rise or demand rise. I think they're both going to move evenly across here into the summer, and it'll probably stay flat, but we'll see.
Yeah, I think. Yeah, and I think we chatted about that last month. I mean, I think everyone gets overwhelmed by the January, February market because of the lack of listings. And as we move to the spring, it's very typical to see more places hit the market, more options, which is why we told our clients not to get too panicked, you know what I mean? When they're not seeing stuff, because we're definitely going to start to see more listings. Now, one thing I saw, and I thought I'd kind of get your feedback on, I mean, it was kind of, I was out looking at some places with some clients on the beach. We saw 4 properties, and it was kind of like an interesting case study because one of the homes had been sitting on the market since October, kind of relisted a couple of times, taking offers anytime. Another home was kind of newly listed, priced well, offers anytime. And then the other 2 were priced low with an offer date, and all these homes were kind of, I don't know, 2 million price point. The one that had been sitting on the market since October sells, okay? The one that was priced properly, reasonable price, sells within a week. The 2 that had offer dates both got multiple offers, I think 3 or 4 offers. Both of them refused to sell and then increased their prices substantially above what they were asking. And I've been noticing this, and again, this is this disconnect between what buyers are willing to pay. You have 3 bids, you have 4 bids, you have 5 bids. Buyers are saying this is kind of max price, and the sellers are saying, no, I want that plus an extra 150 or 200 grand. And I don't know if you guys have seen this. I mean, I was talking to a reporter as well recently who was writing a story about that. And I said, interesting, because I've been noticing in that. So what have you guys kind of been seeing that type of trend as well?
Yeah. Go ahead, Devin.
Yeah, I mean, you see that all the time. It's not a new thing, right? I think the disconnect is newer. Only in so much that if you get 5, 6, 7 offers, unless the other agents who are presenting those offers are a bit out to lunch, you're probably getting reasonable market value. Like market value, given like what are people willing to buy in a sort of rational environment. One would argue that the sellers are being a little irrational at this point. But yeah, it is happening. It's interesting though that the ones that were priced high, the ones that sold, and the one that was priced overpriced. That's interesting that one finally sold. I guess they kind of just decided it's time to.
And for under asking, of course, and they took a reduction. They sold for whatever 4 or 5% under asking. Yeah, and this does happen. I think it's surprising this time of year. Like, I don't know. I find that those types of, cancel the listing, increase the price happens usually later in the season when buyer demand starts to trickle down and offer nights are less predictable. Like I find it's less common in January, February. And I think this is just the seller's psychology, maybe like Gus is saying, where they're just bullish and optimistic that they're going to get whatever they want if they just wait a little bit longer.
I think there's some management of expectations where you can't tell a seller that, you know what, this place is perfect. We're going to get a dozen offers.
Yeah.
If you get 5, it's like a disappointment. And therefore you're automatically going to get something that's less than what your expectation is. And that's not necessarily true. I mean, the seller and selling agent should have already gone over like a CMA for their own home to know what it's actually worth. And if those numbers align with the offer sheets and what you have as a perceived value, then you're okay. If there's a big disconnect, either yes, offers are undervalued or you severely overvalued the home. That's really only one of the 2 things.
I think what you said, John, is really key. I mean, yes, Davin's correct. It does happen. It's not abnormal, but it's that it's happening in February is what's surprising me because, and I think this is, it's part of it's a look into how quickly the market is moving and how quickly things are changing and how volatile it is, because this doesn't usually happen until, you know, April, May, June, where everybody's like, I'm tired of the bidding wars, I'm tired of this, I'm tired of the competition, and most of the buyers have bought, and we've seen most of the higher prices, and then it starts to kind of calm. To see it this early, I think is a sign that I think we're gonna peak and then again like kind of flatline pretty quickly. It's kind of like the all that pent up demand from fall is now pushing through January and February and before. So
Wow.
yeah, and they're too high. Like I've talked to neighbors and other people, and they're like 1.4. It needs a whole total cut. Like yeah, but that shows. And I've been tracking a few others where I've seen. There was one in the West End at Etobicoke, the same thing. They were listed $1.1 million, and I think they got about 8 offers, and then they relisted the next day. And yeah, it looks a little higher than it should be. So that's interesting. That's happening so early in the market as opposed to seeing that happen later on May, June.
Yeah, definitely. Urmi, I don't know if we have any questions. I know there's some potential issues with YouTube here with the chat, but
Yes, we had one. For anyone else that wants to keep asking their questions, you can email me at editor@movesmartly.com if you're having trouble with the chat. Here's one for you guys. Is it possible to try and find a tenant that only wants it for 1 year? Good due diligence interviewing, while no guarantee it's possible?
I mean,
you
yeah,
can't
it's
write that into a lease agreement. It
Yeah.
automatically goes to month at the end, whether
yeah.
the people want to or not. So in short, no.
Yeah, can you unpack that, Davin? Like why that's not as easy as it sounds?
Yeah, so when you sign a lease agreement for, usually it's a year. You can sign it for 2 years. You can sign it for, whatever. Once that year is up, yes, your term is up. But you don't need to re-sign a new lease agreement. What happens is it automatically rolls into month to month, and then the same rules apply for if a tenant wants to vacate, or if a seller needs them to vacate via sale, or family moving in, and family being family up and down. So mother, father, daughter, son. Can't be your brother or uncle, which is another kettle of fish. So I guess only through due diligence is the only way you can do it. I don't know if there's some like outside agreement one could sell. I'm not sure if it goes against the Residential Tenancies Act, but yeah, there's not really going to be a guarantee.
I think what the question's trying to get at, and maybe you can, is like, can you try to find someone who basically tells you they only want it for a year, right? Like they're here for like a student study thing or like a position for a year. I mean, I think in theory it's possible. I think it's hard to find someone who tells you up front, I only want it for 12 months.
Could you, at the time of signing the lease agreement, also sign an N11?
I don't think you're allowed to do that.
No,
I
I
don't think
don't.
you're allowed to do that.
Seems like a good idea.
The other issue is the discrimination. What do? You list it, and then somebody says, "I'll take it for 2 years." No, I'll take it or I'll take it for 1 year, and I may stay. No, I'm gonna wait to find that person that tells me they only want it for a year.
Yeah,
What
it's
do you do?
hard.
You're interviewing people. It's really tricky, guys.
Yeah.
And you don't know what the intention. Life happens. A year later, 9 months later, life happens, and they gotta stay because they lost. Knock on wood. I don't know. They don't have the same income to buy or move or something just changed with their jobs.
Yeah.
Yep.
Very good. Urmi, I don't know if we have any others with for now before we bring David on.
Let's get one last question. Is the market being driven by domestic demand, or is it foreign money making its way into the market regardless of market sentiment? John, there's been even more attempts to try to double down on foreign investors, but are they really the key actors right now?
Yeah, I don't. So we have a lot of measures in Canada kind of trying to prevent foreign buyers. We don't have any real measures trying to reduce foreign capital. But that's not going to happen. Like at the end of the day, if the home's being bought by someone who's a permanent resident, I mean, it's very hard to control the flow of capital that's going into the housing market. But, I mean, the main answer to the question is that most of the buying are domestic, permanent residents. citizens buying homes. I mean, if some are getting gifts from family overseas, I mean, yeah, that's possible, but I don't think that's the majority. Again, that obviously, of course, happens, reports about, people using housing for money laundering, people kind of bringing cash from overseas jurisdictions and getting kind of these shady mortgage. Yeah, okay, that happens. I mean, but again, I don't think that is the dominant trend. That is not the dominant trend is, people who just want to buy a home and want to live in it. And there's not a lot to choose from. So I'd say the dominant driver of the demand right now are just domestic buyers who need a place to live. And there just aren't a ton of listings, especially for family-sized homes.
All right.
All right, beautiful.
Thanks to Davin and Gus.
All right, guys, thank you again for joining us this month.
Thanks for having us.
Next time. Beautiful. And I'll bring on Mr. Larock there, hopefully.
Hello, sir.
Hello, sir. How are you?
Good. How are you?
All right. For those of you who joined us late, David Larock is our resident mortgage expert. Writes weekly on our blog at Move Smartly. If you have not followed his market updates, you really should. So I wanted to kick off to get your feedback on what the heck is happening in macro news. Things are shifting. Bond yields and fixed rates appear to be shifting and not in the direction people want. So maybe you can kind of unpack maybe some of the latest macro trends that might be kind of impacting the mortgage market.
Sure. Well, lots of volatility in the bond market, and I'll focus on the U.S. bond market because that's where the volatility starts. And in terms of Government of Canada bond yields, which our fixed mortgage rates are priced on, they tend to follow what's happening in the U.S. So we can spend a lot of time on the Canadian market, but if there's a big announcement out of the U.S. that drives U.S. Treasury yields up or down, Canadian bond yields are going to get dragged along. And in the U.S. lately, we've had stronger than expected data. If you remember it last summer, everybody was piling onto the higher for longer bandwagon. Bond yields were going higher, fixed rates were going higher. Then turn of the calendar, we get into January, all of a sudden the narrative shifts. Everybody's saying the Fed and the BOC are going to start cutting as early as March or April. Then we start getting stronger data. So for example, we've had the US GDP data came in higher than expected. It showed 3.3% in the fourth quarter. That was way higher than expected. Then we had a banner US jobs report, 335,000 jobs, double the consensus forecast. So all of a sudden then, and the bond market shoots first and asks questions later, we had bond yields surging higher because it looked like, it's going to take longer before the Fed starts cutting, and maybe we won't actually see as many cuts as we thought. So the bond market was expecting the Fed to start cutting in March, April. Now it's pricing in the first cut in June, and it was pricing in 6 cuts. And now it's pricing in 3 or 4 cuts. And when I say cuts, 0.25% would be a typical cut. So if it expects 6 cuts, it thinks that the Fed's policy rate is going to drop by 1.5%. Now it's pricing in anywhere from 0.75% to 1%. So lots of volatility in the market. Interestingly, John, I don't share the consensus view. I'm a contrarian, fair warning. I'm a contrarian by nature. But for example, in the US, one thing we've had right now that's throwing off a lot of the data, and it doesn't get enough mention, we've had a really warm winter. And in a lot of the data that gets put out, there are seasonal adjustments made to smooth out a drop in the data that is due to seasonal factors. So for example, to use a simple example, in the winter, it gets really cold and a lot of construction happens outdoors. And if there's tons of snow falling and high winds and it's freezing cold, you get less construction activity. So the statisticians look at that and say, you know what, in the winter, construction activity tends to slow, but it's not a sign of weakness in the economy, it's a sign of cold weather. And so we're going to fudge our numbers to account for the fact that when it gets cold, some activity slows, and by smoothing out that variance, we're going to try to eliminate some of the noise, which misrepresents what's actually happening in the underlying economy. When you get a really warm winter, like we've had a record warm winter in Canada and the US, then that same smoothing happens. But because actual construction is allowed to happen, again, back to that example, outdoors, because it's warm and there's no snow on the ground, so you can get more construction, then that looks like a big jump, when in reality, the weather was warmer, and as a result, the slowdown that was expected and priced in or priced in, accounted for in the data, never materialized. So everybody's like, wow, look at all this strength. Meanwhile, it's really just the weather report. The other thing to look at, John, is the composition of the data. We've had a really strong Canadian employment report. The headline came in much higher than expected last week, but as I wrote in my most recent post, when you actually look at the details, all the jobs were part-time. We actually lost full-time jobs. Most of the jobs were in the public sector, and public sector jobs aren't subject to the business cycle in the same way that private sector jobs are. Too many public sector jobs are not a sign of strength in the economy. There were various signs in the underlying data. And again, the employment report is a lagging indicator. It tells you where we've been, not where we're going. And for example, in the US, employment data was strong, GDP data was strong, but today we just got really weak retail sales. And retail sales is a forward indicator. It tells you where the economy is going, not where it's been. So interestingly, the surge we saw in bond yields after at the end of last week, and then we got the stronger than expected U.S. inflation data this week on Tuesday. Inflation was 3.4 in December year over year. It came down to 3.1, but the market was hoping for 2.9. Bam, U.S. bond yields took off. Government of Canada bond yields followed. It's a day later, and all of that run-up is basically already left. It's already left the market. So the bond market typically reacts to the headline first, and then everybody takes a few minutes to actually read the report and says, wait a second, this isn't as good or as bad as we thought, and boom, you see it priced out. So lots of volatility in the market, but the reality is we're basically about where we started the week after a big run-up. And the same was true last week. We saw a strong market reaction, but then ultimately nothing is really moving the needle. What is changing is the bond market is expecting it to take longer for the first rate cut to materialize. The consensus now is that it'll be in the summer, which I've basically thought throughout. The total number of cuts is expected now to be less than it once was. But again, this could change very quickly. And as I said in my most recent post, a lot of the market watchers have assumed we're getting a soft landing because we haven't had a recession yet. And in my post, I said the average gap between the first rate hike by the Fed and the BOC and a recession is 14 months, and it's now been 18 months. But then I showed a chart of the last 40 years, and there were lots of times where it took longer than that. And then I listed some reasons why rate cuts were taking longer to hit the economy this time around. For example, we've seen a lag because there were lots of people had pandemic savings. So they didn't, when prices went higher and borrowing costs increased, they didn't have to cut spending because they had pandemic savings buffers. In the US, there was a lot of student loan forgiveness. That meant that, again, people were given a buffer to allow them to absorb higher costs. In Canada, we had fixed payment variable rate mortgages where the payments weren't adjusting. The rate was going higher, but people were in situations where their payment wasn't even covering the cost of interest, but that was okay for a while. The regulator was letting the lenders give those borrowers increased flexibility. So there are lots, and by the way, you get this warm weather scenario in the winter making the data look stronger than it is. Everybody wants to believe we're going to get a soft landing. We almost never do. What we have is a longer than normal delay, and I firmly believe a recession is still coming, and it'll probably come right about the time the last of the mainstream consensus narrative believes that it won't come, because that seems to be how things work, right? The market thinks one thing's going to happen, everybody believes, and then boom, all of a sudden something else happens. That seems to be as true as the sun will rise and set. So we'll see what happens, but in terms of volatility, there's lots of it. Overall, the belief is it's going to take longer for rates to start dropping, and that we'll see fewer drops this year, probably some of them pushed into next year. My contrarian belief is we're not getting a soft landing. The recession is just delayed, not failing to materialize. And that's a long answer to your question, John.
Right.
But there you go. There's the baseline.
All right. So it sounds like we are, I mean, and I know you've written this in the past, but we're in this phase right now where in some ways good news is bad news. So good kind of market indicators, good jobs numbers, good GDP numbers is bad news if you're hoping for rates to drop, right? And this is partly why we've seen this sort of reverse in bond yields, which is kind of are going up. Now, I guess my question is, how is that kind of translating into the fixed rate market? Are fixed rates starting to edge up? And do we think that this might take a little bit of heat out of the market? Again, I think part of this shift is the demand we saw is like rates started plummeting, people rushed in, they thought rates are going to get, drop quickly sooner. And if they stay stickier and higher longer, is this going to take a little bit of heat of the market? So a couple questions for you there.
Sure. Well, interestingly, John, we've seen a big run up in bond yields since the start of the year. And so far, that has not been reflected in fixed mortgage rates. And that's a function of really two factors. And I mentioned this again in my most recent post. Number one, lenders were enjoying wider gross spreads than they typically do. When we saw bond yields fall in January at the start of the year, lenders, as I often say, take the elevator on the way up when they're raising rates and they take the stairs on the way down. They were taking the stairs on the way down. So part of the reason why we haven't seen a big increase in fixed rates thus far in the recent bond yield run up is because there was a lot more spread for lenders to work with. Basically, they could absorb that increase. The other thing is we're heading into the spring market and it's been a slow winter. So lenders are a bit hungrier than maybe they would be when they're all like, everybody's doing lots of business, everybody's fat and happy. They don't sharpen their pencils as much. I'm seeing more of more aggressive competition as we head into the spring market, and that's a good thing for consumers. Interestingly, John, thinking back to the conversation you were having with Davin and Gus, I did want to make one point. Lots of people are saying, well, maybe I'll wait and sell when rates drop because they think that that'll be a better time to sell. But if my theory is correct and we are getting a recession, house prices typically fall during recessions. So you don't just want to think if rates drop in isolation that boom, that means it's going to be a good time to sell and your house is going to go up in value. If rates drop, it'll be because the economy is slowing. And if we get a recession, the last thing people want to do if they're worried about job security is buy a bigger house or buy an investment property. So I think people who are assuming that rates dropping will automatically mean that house prices will go up need to take a bit of a broader view, because typically if you Google this, you'll see lots of statistical evidence. House prices typically fall during recessions. And again, we have to look at the reason why rates drop. But if they drop because we're getting a recession, some people might wish they'd sold now instead of waited a year.
Yeah, I think that's a good point. I think many of the clients who we speak with, I think, are hopeful that are expecting this soft landing where, yeah, maybe we have a mild recession, but not, something very deep. And I think that's kind of what the clients that we speak with, I think, are hopeful of. But you're 100% correct. I mean, we saw obviously the layoffs and job cuts at Bell, and obviously if bigger companies are doing that, and if the cuts are effectively just delayed and they're going to happen in the next half of this year, yeah, they definitely kind of weigh on the housing market. Urmi, I don't know if you have any questions for David.
We do. Sorry, guys. All right. So we have a question from Misha. What happens when you lock in a mortgage rate on the back end? How can you have a lower rate locked in when a new rate can be significantly higher? Who absorbs this difference?
Great question. So let's say you get a pre-approval at 5% and rates go up to 6%. When the lender gives you that pre-approval at 5%, they buy a forward hedge in the market and basically lock in the spread they would make if you converted that interest rate. So in answer to your question, who loses money? The person selling that hedge to the lender loses money. The lender, because they hedge that rate, which basically means if you lock in a pre-approval rate today at 5%, there'll be somebody out there in the market that thinks that rates are going to go lower, and they're happy to buy a commitment to lend that money at 5% on the bet that rates will go lower. It's very complicated. Maybe they're a company that sells pencils and they've got sales happening overseas and there's currency risk, and their finance guy comes along and says, we need to buy 5-year money, and if we lock it in at today's rates, we can lock in our spread. In the lending world, there's an expression, always the bookie, never the bettor. Lenders are never betting on rates. Anytime they're putting out a commitment to lend to you at a certain rate, they're turning around and hedging that rate. And when they do that, they're protected, and whatever spread that they've got between the rate they're lending to you at and the price they paid for the hedge is their profit. And when the market moves, they're protected.
All right. And considering what, John, both you and Dave were just talking about with the perspective, maybe that softer landing not happening as softly as we might want. A question here from MLS. How will all of this affect the real estate markets on the periphery of the GTA, like Hamilton and Orangeville? So I presume, these are areas that did see a big price rise during that COVID exodus. What do you think the prospects are if there is a slower market?
Yeah, I mean, that's a great question. I mean, I think all of Southern Ontario, quite frankly, has been hit the hardest, out of all the regions in Canada. Southern Ontario saw the biggest decline in prices, saw the biggest decline in sales. And I think they're all connected. And I think kind of what's going on with Toronto will probably spill over into the Hamilton market. We're starting to see a lot of people who just can't afford sort of GTA who are moving to some of these regions. I mean, especially when we're talking about Hamilton and Orangeville. So I do think it's probably going to be a bit of a spillover of what's going on in the GTA.
And I have a question for Dave. I think at the end of January, we saw a headline talking about warnings towards banks for Canada's financial watchdog cautioning banks for overuse of fixed payment variable loans. So the idea here is to help households who are, having to deal with interest rate increases that were really quick and unprecedented. Many people had their payments sort of fixed. Now, what that meant is they're not paying any interest in some cases at all. And as I'm wondering what, Dave, your thoughts are on that, especially if rates, don't fall as much as we think, as quickly as they think they might. People are expecting. Is this problem going to get bigger?
Well, the regulator's concerned about it because they don't like the idea of negative amortization mortgages. The issue of a fixed payment variable never really came up because rates were falling for 25 years and nobody imagined that rates could triple in a short period of time. But now that it's happened and we've ended up in a situation where people basically are no longer even covering the cost of interest, that's very concerning for the regulator. So when the regulator says something, and again, they don't want to be seen to be telling the market what to do, so they use very generic wording that is sometimes even hard to interpret. But when they say something like, we're concerned about fixed payment variable rate mortgages, what that means is, hey, lenders with fixed payment variables, watch out. We're about to take a sledgehammer to this product. Now, they won't say you can't sell the product. What they'll say is lenders, guys, have to put aside a certain amount of capital for each mortgage that they have. And it's a small percentage of the loan. So if they're lending out 100 grand, maybe they have to have 5 grand on their balance sheet tied to that mortgage in case there's any losses on it. And their actuaries say that based on the history of losses, that's enough over a portfolio to mean that the balance sheet of the lender is sound, and the regulator is satisfied with that. The lender might come along or the regulator might come along to the lenders, and I think they alluded to this, and say, if you have a fixed payment variable now, you don't, and there's a cost to setting aside that 5 grand, right? The lender has to basically park that money, and that's part of their cost of doing business. If the regulator comes along and says, if you have fixed payment variables, they're riskier because we've ended up in these negative amortization situations, so you don't have to put aside 5 grand for these products anymore. You have to put aside 10 grand. If they do that, the cost of fixed payment variable rate mortgages goes way up overnight. They become uneconomic. and lenders who offer these products start pulling them and going back and having adjustable rate variables. That will happen behind the scenes. They've basically said they're going to do that. They're going to require a higher capital allocation on fixed payment variables. And there, it's happening behind the scenes. The regulator is absolutely telling lenders, in effect, this is a crappy product, we don't want you to sell anymore, but they're not hitting them over the head with a hammer because this is all very, it's all done behind the scenes so that the lenders, it doesn't look like the regulators telling the lenders how to do business, but by raising the cost and the capital allocation for that product, which quite frankly, you can't really blame them for doing, it did kind of go sideways. That's what's happening behind the scenes. And long story short, Urmi, I think those products will be gone in short order. I'd be surprised a year from now if they're still on offer, or if they are, they'll be offered at rates that are significantly higher. And borrowers will then have to decide, do I want to pay more for a variable rate mortgage where the payment is fixed, or would I rather take the lower rate? Generally speaking, in my experience, borrowers would rather have the lower rate. So I suspect if the products are still offered, there'll be very few people taking them.
Interesting. And let's maybe finish on another technical question. Is the 5-year bond market affected by the Canadian-US exchange rate? So, we often hear that it's market sentiment in the bond market. How does that exchange rate figure in?
Sure. Well, they're definitely related as far as which came first, the chicken or the egg. When, for example, if the bond market thinks the Bank of Canada is going to cut before the Fed, then that would typically cause the loonie to weaken against the greenback, because people would say, well, if I'm going to get a lower return on my short-term Canadian money, then I'm going to buy more US short-term money, and you're going to sell your Canadian dollars and buy US dollars. So if that's the case, it can be a bit of a self-reinforcing cycle, because at that point, okay, well, if the Canadian dollar gets cheaper, that means Canadian exports are going to be more competitive in the market. That's going to be good for the economy. Maybe the economy does better, in which case the Bank of Canada isn't going to be able to cut by as much as we now think they will. So it's a bit tough to say. They are definitely tied together. Generally speaking, I would say, do they tend to move in the same direction? I want to be careful about that. There's economists who've been doing this for 30 years who could give you a more confident answer, but no, they're definitely related. They are driven in many cases in the same direction by similar factors, but it's not true that they follow each other in lockstep, and one definitely doesn't always follow the other. Sometimes they take turns in the lead. I guess I hope that's a safe answer. If somebody writes an angry email with a long reply, the next time we do this, I should issue a retraction.
No. Who could be angry with you, Dave? So
well, if I'm wrong, I'm all ears.
All right. So nicely tell Dave if you have some other thoughts. Actually, on that note, I think that's the end of our questions. Maybe it'd be good, John, to share out your Twitter handles.
Yes. Mine's pretty easy. I'm just at John Pasalis. David, you want to share yours?
My Twitter handle, I gotta look it up, guys, because I think it's
Dave IMP, isn't it?
No,
that's
Dave
right.
_ IMP.
There you go.
Yes.
So easier to find. Those handles are in our show notes for today's episode. And you can also find other contact details for our show, as well as links to John's latest market report and Dave's latest blog on Move Smartly. So I think that's it for questions. Thank you both.
Yeah.
John,
thanks,
over to
everyone.
you to wrap us up.
Yeah. Thank you, everyone, for joining again this month. We'll see you in a month's time with David and Gus and Davin with the latest trends. If you have any questions between now and then, feel free to send them over at askjohn@movesmartly.com, and we'll see you all next month. Take care.